Adobe stock has not been having one of their best years. It's currently down over 11% from the recent highs, but it's actually trading at a price over 25% lower than its all-time highs back in 2021. However, Adobe has grown a lot in this time period. In 2021, they had a total revenue of $16 billion and a net income of almost $5 billion. Currently, they have a total revenue of $19 billion and a net income close to $5.5 billion. This company has been growing quarter over quarter at an extremely consistent rate, and although it may not be explosive growth, it's predictable. And the thing I may like the most about this company, it's its insane ability to generate free cash flows. Just look at, first of all, its consistency and the fact that it's always above net income. But what's the reason behind the over 10% drop in the stock price? Well, one of the main reasons is that when they reported Q3 earnings, although they were good, the market did not like their guidance. They actually came in with weaker guidance for Q4 than what was expected, which caused the stock to drop. So today we'll be looking deeper into this, see if the market has actually overreacted, dive deeper into the fundamentals of Adobe, and work out whether this will be a good investment today or if we should just let this stock run without us. So let's jump straight into it. We'll now be going over actually what happened during the earnings call, what happened to the stock, and some strong supporting investment thesis of Adobe stock. However, we always have to look at both sides of the argument, so additionally, we'll be looking at some reasons why investors should wait for the stock to dip even further, and even some reasons of why you should stay away from this stock. But first, let's just analyze what happened. So Adobe shares, which are now over 10% down in the past 3 days, fell because of their weak Q4 guidance. Here we can see that analysts expect revenues to come in at $5.61 billion in Q4. However, the company said that revenues will most likely come in between $5.5 and $5.55 billion. And you may be wondering, well, this is extremely close. Why has the stock dropped so much? When you're dealing with high growth stocks which are trading at very high multiples and high PE ratios, these are extremely sensitive to, let's call it, bad news during earnings season. And the thing is that bad news for these growth stocks is anything that is not beating estimates. Despite this, a lot of analysts are actually reiterating their buy ratings and adjusting their price targets even above of what they used to have it at. The main reason for this is AI generation. They believe that this company knows exactly how to leverage this, how to improve their offerings with these technologies, and how to attract more clients by offering this as an innovative service. A lot of analysts actually went on to say that the sell-off seems overdone. And the thing is that Adobe's Q3 earnings were actually really good. Their revenue beat estimates by 40 million, they have grown over 11% year over year, and their cash flow from operations increased by a lot. As if this wasn't enough, the firm bought back 5.2 million shares this quarter alone, which is great since it shows that it's actually returning value back to shareholders. And this is just for you to get some context over how sensitive these growth stocks are. Their revenue guidance was 1.34% lower than expected, and this actually triggered a 10% drop in the stock's price. The main worry, of course, is growth slowing down. This analyst right here believes that Adobe's valuation has now become reasonable, and they take us through a discounted cash flow calculation that they have done using a free cash flow per share of around $15, cost of equity of 9%, and a terminal growth rate of 3%. Now, the way he calculated this, he says that at the current price, the market is expecting the company to be able to increase its free cash flow per share by almost 13% per year for the next 10 years. Now, of course, this may seem high for a normal company, but this is Adobe we're talking about right here. And the thing is that if we look at consensus EPS estimates, they're actually expected to grow at a faster rate than at 12% for the following 5 years. And for this company, free cash flows have been growing at an even faster rate. So just by following consensus EPS estimates, it does believe like this company is fairly valued. However, in investing, it's not always so simple. We do have to consider a lot of things before actually pulling the trigger on this stock. First of all, Adobe is facing a similar issue to Google, where it's facing a lawsuit that is alleging anti-competitive practices. This company has of course grown so much that it now holds a very large market share. The FTC is actually claiming that Adobe has trapped customers into very long subscriptions where it was actually very difficult to cancel through numerous cancellation hurdles. What they're basically saying is that once you subscribed and paid your subscription to Adobe, it was very hard to cancel because Adobe was actually making that process a lot harder on purpose so that they could earn more money. Now, we have seen a lot of these lawsuits before, and it normally ends up in a very big fine that the company will pay. A lot of these companies such as Google, Microsoft, Apple, and many more giants have faced many of these lawsuits. And the case remains the same. All of these companies have paid all of these multi-million or billion-dollar fines, and in the next 5 years, they've grown at a way faster rate than the market. Then the next thing we should consider is their valuation concerns. Of course, Adobe is a high-quality growth stock, so its multiples are going to be extremely high. They currently hold a 49.3 times price to earnings ratio, which is extremely high. This is why when this company suddenly provides weak guidance or misses on some of the earnings expectations, it is extremely sensitive and the price will drop a lot. Now, one of the main reasons why you should potentially avoid this stock is, first of all, that its growth is slowing down. However, my counter argument to this is that their free cash flow is already at a point where it's growing by such a consistent, predictable amount, and they're even able to return massive amounts of value to shareholders through big share buyback programs, that it's not really about the revenue growth anymore. It's more a matter of margin expansion and free cash flow generation. Point number 2 is that it faces clear competitive threats. Now, this of course is mainly due to AI. Now, I'm not an expert in this market, especially regarding UI and UX. However, this article does argue that Canva has already been chipping away at Photoshop with its more affordable image editing tools. Of course, a lot of big companies are also implementing AI, which makes it a lot easier to Photoshop and edit images, which could potentially chip away at Adobe's margins. And finally, the point that it says that it's not cheap anymore. So Adobe's adjusted earnings are expected to grow at a 12% this year. And based on this forecast, Adobe is actually trading at a 28 times forward PE ratio. I do believe that when we add this to the fact that their earnings are expected to decrease their growth rate, the fact that they have a lot of competitive pressures, their potential regulatory issues, and the fact that I don't understand this industry a lot, are enough for me to stay away from this company. I do believe that they're a great company, that they're performing extremely well, that they have solid growth potential, a very responsible balance sheet, and growing free cash flows. However, at these prices and these valuations, I do believe that there are better options elsewhere. So thank you for watching. As always, this has been the Cashflow Compounder. Please join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.